Hello everyone. Today my team and I will be presenting on China aviation oil scandal that took place in 2004, which was considered to be one of the major corporate failure caused by poor risk management. Firstly, I will be giving a brief introduction. Like I mentioned, the scandal was a major corporate governance failure. The company lost over $550 million due to unauthorized oil trading. Poor financial oversight and weak risk management led to its collapse. The government stepped in to investigate and regulate the company. The main risk caused in the company was when the senior management engaged in unauthorized oil trading, it eventually led to an operational risk. The company suffered huge losses due to oil price changes. The board failed to monitor and regulatory activities. The scandal damaged the investor trust and international business relations was also affected. Some of the key reasons to the collapse was the company bet on falling oil prices but failed to protect itself when the prices rose. There was no proper risk management and monetary system in the place. Financial losses were hidden using fake reports, misleading the regulatory. The board lacked financial experts to oversee the risk and trading activities. The company's trading strategies was highly sensitive to market volatility. So this was my part. Now I will be handing over the presentation to Swaroop. So thank you.
Thank you, Deepa. So my name is Swaroop. I'll be explaining the risk and liquidity analysis of our project. So analysis of financial markets focusing on risk management and market dynamics is risk and liquidity management. So our analysis covers value at risk and trading volumes and daily price spread along with real world applications and investment decision and risk management. So coming to the first part, so value at risk. So value at risk first, value at risk is a key risk matrix which is used in finance, and VAR helps in estimating maximum possible loss in a given time frame at a certain confidence level. So we have taken 95% confidence level, uh, meaning we expect loss to exceed this level only 5% of the time. So the histogram shows in the distribution of, yeah, the distribution of with distribution of daily returns, which the red dashed line makes the fifth percentile of our VAR, and it interprets that extremely negative and represented by the left tail of the return distribution, but the maximum loss as 95% is certainty uncertainty is indicated by the VAR. Yeah, so coming to the next part, so rolling volatility. So we analyze rolling volatility, which measures risk functions over the time. So volatility is calculated using the 30 days rolling standard, uh, which returns to track changes in market uncertainties. So yeah, so it interprets that the high volatility peaks indicates greater market uncertainty, and increase in volatility may linked in major market events and financial crisis. So yeah, so coming next, we have trading volume analysis. So uh, so it is the key measure of liquidity and investor activity. High trading volume and higher liquidity may be easier to buy and sell the assets, and it interprets that increase in trading volume a sign of increased investor activity. Usually it would lead to a price swing, and low trading volume may indicate low investment in low investors engagement towards the liquid, and it would be lead to a less liquidity. And yeah, so the next part would be explained by my friend Buana. Yeah, thank you so much.
Hi guys, now let's talk about credit spread analysis. A credit spread analysis is a difference between yields on corporate and treasury bonds of the same maturity. It's a crucial indicator of credit risk. Recessions may be predicted using the credit spread. And next, we move on to correlation heat map. Correlation heat map aids in the identification of dependencies by graphically denoting links between numerical variables. Darker color indicates strong associations, which is positive or negative. If two variables have positive, that is plus 1, they're said to be traveling together, and minus 1 indicates that they're traveling the opposite directions. Coming to the next part, candlestick chart for price movements. In technical analysis, candlestick chart is frequently used to examine price changes over time. The open, high, low, and close prices are all provided. Candlesticks, the color green indicates the increase in price, and red indicates decrease in prices. Candlesticks, large wicks may be a sign of market hesitancy. And next, at the end, we have daily spread price spread analysis. The difference between the daily high and low prices is known as day price spread. It is used to quantify intraday volatility. High prices and fluctuations in market uncertainty are indicated by wider price spread. High price spread periods are indicative of higher market volatility. Market conditions are stable when spreads are lower. But the next thing we can conclude by saying that our analysis uh, has covered key metrics such as liquid indicators, credit market conditions, and technical analysis tools, which helps professionals, financial professionals, and investors in making better decisions, managing risk, and optimizing portfolios. And by combining volatility risk, credit spread, trade volumes, and candlestick patterns, we can gain a comprehensive view on a market behavior. Thank you, and next will be continued by Ashwin.
Good morning, everybody. Thanks, Boona. I'll be now starting with the mitigation proposal. This proposal basically analyzes the shortcomings in the existing risk management practices. It evaluates organizations' response and it will propose a risk mitigation strategy to prevent future occurrences. Moving forward, we will now see the shortcomings in the existing risk management practices. Inadequate internal controls and poor understanding of the financial instruments were two of the shortcomings in the existing risk risk management practices. The CAO scandal was driven by inadequate internal controls and lack of comprehensive risk assessment structures. Poor understanding of financial instruments promoted a corporate culture where short-term performance were given more priority over prudent risk management structures. Adding up to this, corporate governance failures and systematic weakness was also a factor causing the scandal. Lack of regulatory oversight in China and Singapore enabled company leaders to function without proper controls, resulting in inadequate supervision. Poor risk management practices. The scandal exposed numerous issues related to poor risk management practices in Chinese companies. CEO's immediate response to the scandal was firstly, they were making public excuses and commitments because they wanted to restore the stakeholders' trust. Internal investigation. The appointment of the independent committee to conduct an internal investigation raised questions about the integrity of the governance model itself. Resignation of high managers. Corrective measures included resignations and replacement of managers who implicated in the scandal, though reforms were insufficient to address the root cause. Limitations of CEO's post-crisis reforms. Superficial approach. gaps in risk management, training, and ethical compliance. So we will look at it one by one. Regulatory reforms started post-crisis were criticized due to lack of depth necessary to transform CEO's risk management framework. There were gaps in the risk assessment. The implemented response highlighted significant gaps in the CEO's pre-existing risk assessment protocols, allowing speculation on the prices of oil. Training and ethical compliance. Training programs aimed at improving compliance and ethical standards were questioned for their effectiveness without a rigorous ethical framework. We will now move on to the need for the risk mitigation strategy. There are three parts in that: risk management training, regular audits, and regulatory standards. Active risk management and improved corporate governance require a comprehensive approach to overcome the failures in the CEO scandal. This will include risk management training, regular audits, and strict regulatory standards to create a sustainable improvement opportunity. What are the recommended preventive measures? Enhance training. Enhance training. We should prioritize extensive training programs for the employees at all levels. We will also conduct uh, regular audits. Implementing regular audits is very important to assess both financial and operation dimensions. Strengthening compliances aligns internal practices with external regulatory standards. So these three measures are very important to prevent for future risks. Now, I will conclude this by saying, strengthening management and ethical practices is very important. Establishing a transparent culture of risk management, reinforced by integral training and regular audits, strict regulatory adoption of best practices forms the basis of risk mitigation improvements. These measures can often strengthen organizations' future operational interruptions and cultivate a deeply rooted commitment to ethical practices throughout the aviation sector. Thank you guys for your time.